Simply saving money guarantees a loss of purchasing power as inflation erodes your balance. To actually grow your wealth, you have to transition from a saver to an investor. Most beginners start by trying to research and pick individual winning stocks, hoping to find the next big mover. That strategy fails most people. Outperforming the market requires massive daily research that is impossible to sustain if you have a full-time job. This flowchart maps your two main options. On one side, you have a tangled red web of research and volatility. On the other, a clean, straight green line representing the index approach. Treating stock picking as a casual side hustle burns capital. Time-poor investors need a structural, automated solution to manage their money. The exchange-traded fund, or ETF, solves this dilemma. By purchasing one single asset, you automatically distribute your capital across the top-performing companies of an entire index. The fund is self-cleaning. It automatically rotates out failing companies, the donkeys, and replaces them with growing companies, the horses, without you ever lifting a finger. In India, this means anchoring your portfolio to the growth of the top 50 companies listed on the National Stock Exchange. But we can go further. We are going to learn how to curate and combine just 3 specific ETFs to maximize your growth and survive market crashes. Using ETFs means trading the lottery ticket dream of a 10x stock pick for mathematical consistency and zero daily maintenance. We start with a baseline strategy, allocating capital to broad domestic ETFs like Nifty Bs or mid-cap index funds. This captures the average growth of the entire Indian economy with no research required. The trade-off is that you are bound to the average. Owning the whole market prevents you from generating alpha, or returns that significantly beat the market standard. Investors seeking higher returns must look at aggressive alpha ETFs, specifically Momentum 30 or Small Cap 250 funds. This matrix shows the split. The top row is the Nifty 50 baseline, average returns, low volatility. The bottom row is Small Cap 250, high alpha potential, severe volatility. If the broader market dips 5%, a small cap ETF might plunge 15%. Chasing these higher returns requires you to explicitly accept a mathematically higher probability of steep short-term drops in your portfolio value. International exposure provides a third tier of aggressive growth, specifically targeting U.S. tech monopolies through NASDAQ or FANG ETFs. This moves your capital into the most dominant tech sector in the world. For Indian investors, U.S. ETFs offer a unique structural advantage: currency arbitrage. Domestic currency value constantly fluctuates against the US dollar. If the rupee depreciates against the dollar, the INR value of your US-based ETF rises automatically. You gain an extra layer of returns purely from the shift in the exchange rate. US ETFs provide exposure to global monopolies while acting as a financial shield against domestic currency depreciation. Every aggressive choice we've discussed, small caps and US tech, is highly vulnerable to inevitable market crashes. To survive, allocate 20 to 30% of the portfolio to gold. It is inverse correlated to stocks, meaning it rises when equities fall. Buying physical gold is an incredibly inefficient way to build wealth because of the massive hidden costs involved in the purchase. Cultural tradition pushes us towards physical gold. It feels like ultimate security. This waterfall chart shows the mistake. On top of the base price, you pay jeweler premiums and a mandatory 3% GST. That capital is instantly gone. A gold ETF tracks the base price exactly. You bypass premiums and taxes, keeping your money working. Gold ETFs do not pay dividends. During a multi-year bull market, this allocation will act as a drag on your total portfolio returns. Gold exists to act as a structural hedge. It prevents your total portfolio value from being wiped out when the rest of the market collapses. We are now combining 3 non-correlated ETFs into a single strategy designed to manage your specific psychological tolerance for risk. These blueprints allow you to match your portfolio to your reality. A conservative portfolio combines the Nifty 50, a mid-cap fund, and a gold ETF. This suits the beginner who wants average returns and the ability to sleep soundly through market volatility. The aggressive portfolio uses Momentum 30, NASDAQ, and a gold ETF. This targets alpha and currency arbitrage, but requires the iron stomach needed to endure deep price drops. A successful portfolio relies on architecting a combination of assets that ensures you never hit your personal panic threshold. There is one non-negotiable rule. Regardless of how aggressive your equity choices are, you must include a gold ETF. You need a heavy, steady weight to hold you firmly in place when the market conditions get extremely turbulent. When the market collapses, that gold ETF is the only psychological anchor that prevents you from panic selling your stocks at the absolute bottom. Individual stock pickers live with daily anxiety, endlessly checking charts. The 3 ETF investor enjoys automated peace of mind. Long-term wealth comes from building a structurally sound portfolio that allows you to step away from the screen and live your life.